Here's your challenge. How would you prepare if the Federal Reserve's only option was printing money to manage the U.S. debt crisis? Ray Dalio thinks this could be our future. Your mortgage, your savings, your future returns, none of these are immune if things spiral out of control. Could your next paycheck be worth less without warning? Dalio's warning isn't just about big government numbers. It's about what those numbers could mean for your everyday life. If you think the $33 trillion national debt is just a headline, you might want to think again. The real question is, how close are we to a tipping point? Let's talk about the debt crisis nobody wants to talk about. The U.S. national debt now stands at over $33 trillion, and the annual deficit has ballooned to about 7% of GDP, more than double what Ray Dalio considers sustainable. This isn't just a distant government statistic, it's a signal that the financial foundation of the country is under strain, and that strain is already beginning to reach everyday Americans. Here's how it plays out. The government has roughly $9 trillion in debt coming soon. That means it has to either pay it off or refinance it at today's higher interest rates. As those rates rise, so do the government's interest bills. When more money goes toward paying interest, there's less available for roads, schools, and social programs. The effect is a slow squeeze on the services and investments that people rely on, and the pressure doesn't just stay in Washington, it spreads out across the economy. Dalio draws a clear line in the sand. He believes a deficit above 3% of GDP is unsustainable. At 7%, we're not just flirting with danger, we are, in his words, hitting the rocks. Why is this so serious? Because higher deficits mean more borrowing, and more borrowing at higher interest rates creates a cycle that's hard to break. As the government pays more just to service its debt, it has fewer options to invest in the future or respond to crises. History offers a warning. Dalio points to Germany in the 1930s when a debt crisis led to default and major shifts in how the country was governed. He doesn't mention this to be dramatic, but to show that economic imbalances can push even stable societies into unpredictable territory. The lesson is that when debt piles up and faith in a government's ability to manage it falters, the consequences can reshape economies and politics in ways that are hard to undo. So what's the way out? Dalio argues that there isn't a single fix. Raising taxes alone won't do it. Cutting spending alone won't do it. Managing interest rates in isolation won't do it either. Only a combined approach, raising revenue, cutting spending, and careful rate management can bring the deficit back towards 3% of GDP. It's a tough prescription, and the political will to make these changes is hard to summon, especially when costs are immediate but the benefits are long-term. If the government can't close the gap, the risk grows that more drastic measures will be needed. When debt becomes this large, it's not just a line item in a budget. It starts to crowd out opportunities and choices for everyone. Imagine a future where more of your tax dollars go to paying interest on old debt instead of funding things that matter to you. Fewer resources for infrastructure, education, or healthcare. More pressure on households as the government looks for ways to make up the shortfall. And if the cycle continues, Dalio warns, the Federal Reserve might be forced to step in with interventions that go beyond the usual playbook. Printing money to cover deficits is a tool with serious side effects, potentially leading to inflation and a weaker dollar. These are not distant risks, they are the kinds of changes that can affect your cost of living, your savings, and your financial plans. This all leads to a crucial reality. As the government's debt grows and interest rates climb, the impact doesn't stop at the federal level. It shows up in your daily life, from the price of groceries to the cost of borrowing. So what does it really mean when interest rates rise in response to this growing debt? That's what we need to look at next. The hidden costs of rising interest rates reach further into your life than you might expect. When the government's debt soars, it needs to sell more bonds to keep things running. But to convince investors to buy all these bonds, interest rates have to climb. Ray Dalio points out that when the supply of bonds outpaces demand, rates don't just inch up, they can surge. And as those rates rise, the ripple effect quickly moves from government balance sheets to your monthly budget. Let's look at how this plays out for a typical household. Imagine you're in the market for a home. 10 years ago, you could have locked in a 30-year mortgage at around 3%. Today, that same loan might come with a 7% rate. On a $400,000 mortgage, that difference means you'll pay thousands more in interest each year. Money that could have gone toward your savings, your children's education, or even just your peace of mind. It's not just about mortgages either. As rates climb, credit card and personal loan payments follow. If you're carrying a balance, you'll find that more of your paycheck disappears into interest charges, leaving less for everything else. This squeeze on household finances isn't just a short-term inconvenience. It's a direct threat to financial stability. As disposable income shrinks, families are forced to make tougher choices. Fewer people can afford to buy homes or cars, and saving for the future becomes even harder. Dalio warns that these pressures, if left unchecked, could make it nearly impossible for many to build wealth or even maintain their current standard of living. But there's a bigger consequence lurking behind these higher payments. The government, facing its own rising interest costs, ends up spending more just to service its debt. This creates a cycle. The more it borrows, the higher the rates, the more it has to pay in interest. Eventually, this cycle leaves fewer resources for things like infrastructure, education, and social programs. The choices get tougher and the options start to run out. At some point, the Federal Reserve may feel compelled to intervene. What happens when those higher payments force the Fed to step in? Dalio draws a clear line to the past, pointing to the 1970s as a cautionary tale. Back then, the government responded to rising debt and slowing growth by printing money and buying bonds. The result was a spike in inflation that eroded the value of savings and made everyday expenses climb faster than wages. Inflation is the silent cost that can catch families off guard. When the Fed prints money to keep rates in check, the dollar value slips. Prices at the grocery store, the gas pump, and just about everywhere else start to rise. Your paycheck might look the same, but it doesn't go as far. Years of careful saving can lose value in what feels like an instant. Dalio's warning is straightforward. If the government relies on money printing to manage its debts, we could see a repeat of the inflationary pain from decades past. The impact isn't just theoretical. If inflation takes hold, it quietly chips away at your financial security. Groceries, rent, healthcare, and tuition all creep upward. Retirement plans and college funds don't buy what they used to. The cost of catching up can be overwhelming, especially for those already stretched thin. These are the hidden costs that go unnoticed until they're impossible to ignore. Rising interest rates, driven by government debt, set off a chain reaction that can reshape your financial future. The decisions made in Washington don't just stay there. They show up in your daily life, one bill at a time. But what if the real risk isn't just higher payments, but waking up to find your savings don't stretch as far as they used to? That's a scenario worth examining more closely. When you check your bank account, the numbers might look the same, but what those dollars can actually buy could be shrinking right under our nose. This is the core of the dollar dilemma, and it's exactly the risk Ray Dalio wants you to understand. The issue isn't just about how much money you have, but what that money is really worth when the Federal Reserve starts printing more of it to manage the national debt. The real danger is that your hard-earned savings could lose purchasing power, making everyday life more expensive even if your income stays the same. So how does this play out? Dalio explains that as the U.S. debt grows to unsustainable levels, the government's options narrow. To keep up with interest payments and avoid default, the Federal Reserve may step in, buying up government bonds and injecting more money into the financial system. On paper, this keeps borrowing costs down and helps the government function. But the trade-off is serious. Creating more dollars without real economic growth behind them means each dollar in your wallet is worth a little less. Dalio warns it mirrors the 1970s, when printing money fueled double-digit inflation and erased savings value. Inflation works quietly at first. You might notice the price of milk going from $4 to $5, or your weekly grocery bill creeping higher. But it doesn't stop there. Rising prices stack up across rent, utilities, healthcare, and transportation. Each time you pay more for the same thing, your savings lose ground. If your paycheck doesn't keep up, your standard of living slips. And if you're relying on a fixed income or a savings account, you're hit even harder because those dollars buy less every month. History shows how quickly this can escalate. In the 1970s, the Federal Reserve's efforts to stimulate the economy with easy money led to a sharp decline in the dollar's value. Prices for everyday goods soared, and the interest paid on savings accounts couldn't keep up. The result? Families watched their purchasing power drain away, even as their account balances stayed the same. The lesson from that era is clear. When inflation outpaces your returns, you lose wealth even if you never touch your savings. This isn't just a story about groceries and gas. Inflation chips away at investments too, especially those considered safe like bonds. If you own a bond that pays a fixed interest rate, rising inflation means the real value of those payments shrinks. You might receive every dollar you're owed, but each one is worth less than when you started. Over time, this can undermine retirement plans or college funds that depend on steady, reliable growth. The dollar's role as the world's reserve currency adds another layer of risk. For decades, global investors have trusted the dollar as a reliable store of value. But as U.S. debt balloons and the Federal Reserve prints more money, that trust can waver. If confidence in the dollar drops, the cost of imported goods rises, and your dollars lose buying power abroad. Everyday items that rely on global supply chains, electronics, clothing, even food, can get more expensive, making inflation an even bigger problem for American families. So how can you shield your savings if your dollars start losing value? Dalio's advice is straightforward. Don't rely solely on cash or traditional savings accounts. Instead, consider spreading your investments across assets that tend to hold their value when inflation rises. Gold is a classic example. It's long been used as a hedge against currency declines. Real estate can also provide a buffer, since property values often keep pace with inflation. Some investors look to commodities or inflation-protected securities as additional safeguards. The key is diversification. By not putting all your eggs in one basket, you reduce the risk that inflation will erode everything you've worked for. It's not about eliminating risk entirely. No strategy can guarantee you'll be untouched by inflation or currency swings. But by preparing in advance and making thoughtful choices, you can help protect your purchasing power and financial security, even if the dollar faces tough times ahead. Taking action now can make a real difference. Dalio's message is clear. The cycle of rising debt and potential money printing isn't just a policy debate. It's a personal financial challenge. The warning signs are there for anyone willing to look. The question is, what steps will you take to protect your money before the next wave of changes arrives? Your savings won't survive passive waiting. Protecting your money in this environment demands more than hope. It requires a plan. Dalio's advice is clear. Preparation beats reaction. With inflation, rising rates, and currency risk moving faster than most people realize, the stakes are personal and immediate. The cost of groceries, rent, and energy already reflects these changes, and if you do nothing, your purchasing power could quietly erode even further. Start with diversification. This isn't about spreading investments thinly, but about including assets that behave differently when inflation rises or the dollar weakens. Gold, real estate, and Treasury inflation-protected securities, TIPS, are all assets Dalio points to for their resilience. Gold and real estate can hold value during turbulent times, while tips automatically adjust with inflation. So your investment keeps pace with changes in the Consumer Price Index. These aren't guarantees against loss, but they provide a buffer when traditional savings or bonds might fall short. Beyond these hedges, look at your entire investment mix. Dalio notes that economic downturns and recessions have been frequent since 1945, and high debt only raises the risk of a sharper shock. A portfolio that spans different sectors, countries, and asset classes is less likely to be wiped out by a single downturn. For example, stocks in emerging markets or industries tied to long-term trends, like renewable energy, may offer growth even when U.S. markets stall. The key is to avoid putting all your eggs in one basket, especially in uncertain times. Don't overlook the basics. An emergency fund, 3 to 6 months of living expenses, remains one of the most reliable defenses against sudden setbacks. This cash reserve acts as a buffer, letting you handle emergencies or job loss without selling investments at the worst possible moment. It's simple, but it's the kind of preparation that separates financial stability from financial stress. Staying informed is another layer of defense. Watch for Federal Reserve policy changes, shifts in interest rates, or major economic indicators that could signal trouble ahead. You don't need to be an economist, but paying attention to credible news and market updates helps you react early. If you're not sure how to adjust your portfolio, a financial advisor can offer tailored strategies, from rebalancing your investments to managing taxes more efficiently. The right guidance can help you avoid costly mistakes and make the most of whatever changes come next. History shows that those who act early often fare best. During the 2008 financial crisis, people who diversified or moved into undervalued assets saw their wealth recover faster. The lesson isn't to chase the next big thing, but to build a resilient plan that can weather shocks. Diversification, emergency savings, and regular portfolio reviews all add up to a stronger financial position, no matter how the economy shifts. Still, no strategy is foolproof. The future will always hold surprises, and there's no way to eliminate risk entirely. What you can do is make choices that give you flexibility and options, even in the face of uncertainty. Dalio's message isn't about fear. It's about building a foundation that can handle whatever comes, so you're not caught off guard by the next big change. Next, we'll see how those moves could make or break your wealth in the coming downturn. Dalio's warning is clear. Debt, deficits, and money printing threaten your financial future. Act now or risk watching your purchasing power vanish. The steps you take today, whether it's diversifying your investments or paying closer attention to economic trends, can make the difference between stability and struggle as the landscape shifts. If you found this breakdown helpful, let me know in the comments which strategy you'll explore first, and don't forget to subscribe for more financial insights. Staying proactive isn't just smart, it's essential as these challenges continue to unfold.